In this week's update, signs of a short-term top, an historic shift by the Fed, and yet another boost for precious metals. My name is Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. All right, let's start with an overall market perspective. Markets have been moving along really strongly in the last couple of weeks, and we've certainly been consistently at a level of being quite overbought ever since the S&P broke out to new highs, and we're now more than 100 points above that high. So the question is there some sort of short-term high forming? There's certainly some indicators that would support that. Now, for longer-term investors, there's probably nothing to be done here. So let me be clear about that. It's really only for either shorter-term traders who would like to take some profit, or perhaps for people that are just a little less resilient to the sort of volatility that we've seen in recent times. So a couple of things that have me just a little bit wary in the short term. The put to call ratio has really plunged, and the reason that that's happening is that speculators have been buying call options, and buying call options with a fair amount of leverage as well. So that whole sector just looks too hot to me, and generally when it gets to those sort of extremes, we often see some sort of high in the market, at least for a few days or a few weeks. The second thing is that we've got the VIX index is just sneaking up a little bit as stocks rise, and that really is not a particularly great sign either. So I think the odds in the short term, and I'm talking days or weeks here, strongly favour some downside. Now, it doesn't always happen when these ratios get to these levels, so this is not necessarily a given, but certainly the probability would favour a short-term top, and therefore you should just be a little bit more careful, and you probably should do a few things if you're a shorter-term trader or a more nervous investor, just to perhaps lock in some profit, tighten up your trailing stops, those sorts of things. Now, there's no question that we're in a world now, and we have been for some time, where technology is driving change at an ever-increasing rate. But what has happened, of course, is that the virus has sped up those transitions immensely. Things that would have unfolded over the next 5 years unfolded in a matter of months. And it's been really quite an incredible transformation. And it's the ingenuity of mankind that's been on full display here. And this is one of the problems with people that look at valuations in the stock market based on history, because that was then, and we're now in a very different environment. So why would you use the same valuation metrics that you used when we lived in a completely different world? I mean, that doesn't make any sense to me at all. And so the so-called value investors have been left behind for probably most of the last 5 years. And they're still scratching their heads and wondering why. And it's because they're not acknowledging that the world has changed and continues to change dramatically. And it's pretty apparent now that the new economy trends are really here to stay. This is not a fleeting aberration that's going to go back to normal. These new trends are now here to stay because they were going to happen anyway. They've just been brought forward. Now, the Fed, the other key thing, I guess, that happened last week is that the Fed has shifted their policy quite dramatically. And this has huge ramifications going forward from here. They're pursuing inflation to a greater extent than what they've done before, and they've had a 2% inflation target for some time. But what they're saying now is that they're going to stoke the fires. They're going to be prepared to let inflation go beyond 2%, perhaps well beyond 2%, and run hot for a while to compensate for the period that we're in now, where we've got incredibly low inflation. So this is a real game changer. This is a change in the Fed mandate, if you like. So part of the reason they're going to do this, or part of the mechanism they're going to do this, is through seeking ultra low employment. And normally those sort of ultra low employment levels will stoke inflation, and hopefully it'll work, that it won't be a repeat of what Japan's been trying to do for the last 20 years and has basically been unsuccessful. Now, the demographics around Japan and the US are quite different. So hopefully the US is more successful than Japan was in stimulating their economy. But the bottom line is that this sort of Fed policy is not only good for the economy, but it's also good for asset prices as well, and that's the key thing. So it's the Japan playbook all over again in terms of what they're trying to do. But the Japanese economy has been stuck and asset prices haven't responded in the way that they would have liked. So let's hope that that this shift in the Fed policy gets them where they want to go. So what does it all mean? Well, it can only be dramatically positive for both stocks and for precious metals, in my view, and more on the precious metals side when we get to that point. So anyone who doubted the secular bull market really needs to think again. And I've had a few comments over the last few months when I've put that long-term chart up showing that we're in a secular bull market, and people have written to me and said, look, you're crazy. How could we be in a secular bull market when we've got the virus and all of the implications? Well, all I can tell you is you just need to think again. And for the reasons that I've outlined a couple of times, why it's happening is because markets are looking forward, not looking back. And when we come up with a logical conclusion, it tends to be based on what we can see now or what our historical exposure's been. We tend not to form logical conclusions based on how the future might unfold, but the market does, and that's the difference. Turning now to American stocks, the S&P had a really strong week, up 3.3%, and finally broke through 3,500 points, which is just extraordinary to think of where we were on the 21st of March, and now we're at 3,500 points. It's quite incredible. With the probability of a short-term high, it's time for a lot of people to just examine your exposure relative to your tolerance to volatility. If you're a long-term investor and you're okay with some short-term volatility, then do nothing. But if you're a shorter-term trader or you're a bit nervous about the volatility, then you might want to just take a look at that. And to me, it's a little bit like doing the advanced driver training course. You set yourself for something that hopefully doesn't happen, and you set yourself to be aware of potential pitfalls. And we're doing the same thing here. We're anticipating and planning for what might go wrong. Let's hope it doesn't. But if it does, we know exactly what our response is. You need to do this thinking before the event, not once it starts to unfold, because once it starts to unfold, your emotions are fully engaged. It's very hard to come up with clear thinking in that sort of environment when markets are moving very quickly. So plan ahead, work out what sort of trader or investor you are, and take some appropriate steps now. So for traders, you should tighten up your stops for sure, and also tighten up if you're running trailing stops on profit-taking exits, then you probably should tighten them up as well. Okay, the US dollar resumed its decline. We had a little bit of a bounce, pretty predictable, and now we've resumed the downtrend, and we dropped another cent on the trade-weighted index down to 92.25. And the 10-year yield, however, went a little bit the other way, went up to 0.72. All right, let's take a look at some charts. We'll start with the S&P. So here was our all-time high in February, in the middle of February, at 33.94, and we finished the week at 35.08. And you can see how comfortably above the 20-day moving average that this is tracking. If you look at the 20-day, you look at the 50-day, which is the blue line, they're really orientated very strongly to the upside, and then the price is above that. So everything is stacked up very nicely. The 200-day went into a slight downtrend as a consequence of the crash, but the rebound was so fast that the 200-day has flattened out and started to turn back up again. So that's where we sit with the S&P. If we look at the Nasdaq is even stronger. Here's the February high. Look at where the Nasdaq is. The February high was 97.40, and the Nasdaq now is basically 12,000 points. So it's been an incredible run, and this really does underscore just how much better some sections of the stock market are going than others. And look at the NASDAQ down here in this bottom pane compared to the S&P index. It's outperforming the S&P index by a very significant amount. And so that's where the focus needs to be, not on the whole market, just in the sections of the market that are performing, as you've heard me say many times. Here's the US dollar. So we've resumed our downtrend. There's not really any support coming in until about 89.5. So we've still got a bit of a ways to go. And if you look at this blue moving average line, which is the 50-day, it gives you an idea of just how strong the downtrend is. Because the moving average is heading down very strongly and the price is well below it. So this is a very powerful downtrend. While I'm here, let's look at the Australian dollar, and that's pushing the Australian dollar up, of course. And the strength in the iron ore price is also helping the Australian dollar. Now, I just want to show you one other chart, just as one example of numerous in the US market. So this is a company called Salesforce .com. They're basically in the software business, and their revenues in their last reporting period were up 25%. So that's pretty incredible in the period that they've just come through. Also, tellingly, they raised guidance to $21 billion worth of sales. So this is a company with a market cap, I think, of about $270 billion. So this is a pretty big company. They raised their guidance, which of course they don't have to do at the moment. There's no expectation on CEOs to raise guidance, but they did. And this is for the financial year 20. And they also raised their earnings guidance to $3.72 as well. So this is a company that's going brilliantly well. They're confident enough to raise guidance significantly. Now, if we look at the valuations, and this is where a lot of the traditional value investors get stuck. The valuation multiples for financial year 20, which ends in December, the revenue multiple is 11 times. Now, that's not cheap. And the earnings multiple, the EPS, is, or the PE, if you like, is 72 times. Now, the traditionalists would look at that and shake their head and just walk away and say that's, it's ridiculous, it's insane, it can't last. But the market is paying for where the company will be in a couple of years' time. And in a zero interest rate world, what are earnings worth? They're worth a heck of a lot more than they were when interest rates are 5%. That's just, basic laws of finance. And I'd ask you just to consider how Amazon grew into the valuation that people were saying the same thing about Amazon 10 years ago, that it was ridiculous, it was insane. You look at Facebook, the same, Google. These companies have been on very, very high multiples, but the growth was there. And eventually those companies, continue to grow very, very strongly, and the price has gone up significantly. And really the valuations have probably come down. Now you can see the impact. This is a weekly chart, so you can see the impact on the share price that this result had, and also that the forward guidance had. And you got to remember too, these valuations, these are 2020 results. Now the market is already starting to price in 2021. So those valuations with the growth rate will come down significantly. So it's not as outrageous as you would think. And in a zero interest rate world, it's definitely not as outrageous as you would think. So that is why some parts of the US market and some parts of the Australian market are doing as well as they are. All right, Aussie stocks. I've shown you the chart on the Aussie dollar, sharply higher, almost up to 73.5. And it's a little bit more than the current, just the straight currency would reflect. Now, our market was down 0.1%. I think it was down 0.2% last week. And basically, the index hasn't moved in 3 months. So all the major contributors to the index are just stuck. And if you want to make forward progress, you definitely don't want to be a broad-based investor in the Australian market. The deals and the results that are being announced in some of the small to mid-cap companies are powering selected smaller stocks along very, very strongly. There's an absolute smorgasbord. For anyone that's in Portfolio Analyst or the Insiders Club, would know that it's an absolute smorgasbord of opportunities at the moment. And we saw on Friday a company that was already reasonably sizable, $1.2 billion market cap before Friday, and it doubled in price in a single day. So when you see that sort of thing happening, you know that there's certainly some significant buoyancy and significant opportunity in the Australian market in these sorts of stocks. So let me just put a little bit of context to that. Now, this is not a recommendation, so the stock is PointsBet Holdings, PBH, that I guess a lot of people would be familiar with, and they're starting to get more and more media exposure here in Australia. Now, this stock always had the potential to go well beyond $20. We bought in here in both services back in September of 2019, so about a year ago, at around about $3.40, $3.60. Now, the company then always had that potential as they opened up in America. But the deals that they've just done has woken up the market to that potential. So the share price was moving higher, but certainly what was announced on Friday really fired the market up. And there's many other stocks in Australia that certainly have the potential to do this. Perhaps not in a day, that's a bit extreme, but certainly over time to go up many hundreds of percent. So they're the opportunities that you want to look at. And, if you're just following along the Australian market in the traditional kind of value stocks, then, you're really being left behind, in my opinion. And one of the things that you've got to understand, I guess, is that the market is pricing in where a lot of these companies are going. And I'll have some more to say about that in the last slide with respect to value investing and growth investing. Okay, so let's just look at the ASX 200. So you can see here we're really just at the same level that we were at in early June. So the market as a whole in Australia has gone nowhere for the last 3 months. Now, while I'm here, let's look at precious metals. So here's the big picture. This is the peak back in 2011 in gold at just over 1900. We busted out of that. We got up to 2080. We've retraced to the breakout. So this is all pretty normal stuff, as you would expect. We're holding that support level, and we had quite a reasonable week last week. Now, we've come out of the trend channel, which was already strong, that started at the end of 2018. So that was already a strong trend, but we've come out of that and we're now in a channel that seems to be tracing out an even higher rate of ascent. Looked at on the daily, you can see we finished off the week quite well. And looking at silver also has been doing very well after it got really hit hard in the crash in March. So gold up 25, finished at 1965. Is the ABC correction concluding? Yeah, look, I'm not sure at this stage. I think it's a bit early to say, but it's possible that it is, particularly given what the Fed has just done in the last few days. So it's possible that correction is now over, but I wouldn't get too gung-ho on the sector just yet, because time-wise it's a bit soon. I would have expected a few more weeks of consolidation, but look, who knows? We're in a very different world these days. Precious metal stocks, GDX was slightly higher again. The market was assisted by Berkshire Hathaway announcing that they'd taken a position in Barrick Mines. Now, the position is pretty small in the context of Berkshire Hathaway, but it's symbolic because Warren Buffett has been so vocal for decades that gold was just an investment that he would never make. And I guess he's not investing in gold. He's invested in a major gold stock that pays a dividend. So, I think that's a little bit of a sign of the times with respect to how people are perceiving gold and gold stocks. Now, both gold and silver stocks, and I've covered this in recent weeks, the GDXs and the SLVs and those sort of ETFs have been held back a bit because a lot of production was shut in, not in Australia, but it was overseas. And so that impeded the explosion in profits that we expected to see. But pretty much all production around the world is now back on full tilt. And so we're going to start to see the profits of these mining companies around the world start to explode. And that's when you're going to see GDX and SIL and those sort of ETFs really take off, and a lot of individual stocks take off as well. Just let me look quickly at GDX. So there's GDX. It's really on a weekly chart, as you can see, just how rapidly it's increasing. At the bottom of the crash, it was $16.50, and now we're at $42. So it's almost trebled in that time. So a very, very steep rise for GDX, and it still needs to play catch up with respect to the gold price. Other commodities, copper was higher again, so we've broken through $3 now, and it's just reflecting the slowly improving global outlook. Crude oil also rose, really just pretty much currency effect, almost $43 on crude oil. And there's the spot copper chart, so it's been a really strong rebound since March in copper. And I thought I'd just check in on nickel as well. Haven't looked at nickel for a little while, and you can see that the nickel price is also heading up. And whilst this is a longer term story, the rise of the electric vehicle market, which hasn't really reached an inflection point yet, but when it does, these nickel and a number of other metals are really going to take off. And there's some exciting opportunities in the electric vehicle, in the nickel area, in battery technology. There's some terrific opportunities in the Australian market to tap into that. So wrapping it up, yes, some of the valuations seem rather crazy, and that's why I showed those numbers and that chart on Salesforce. But the market is rewarding strong growth, which is highly probable, which the market deems to be highly probable. And the Salesforce results really just reinforce that. This is a contentious point for more value-orientated investors who are just been sitting back, and some of them are quite high profile. So I'm not just talking about individual retail investors, I'm talking about some of Australia's highest profile and most respected investors have been sitting back saying, they're not going to touch this end of the market because it's just ridiculously overbought. But they've been saying that for 5 years or more, waiting for value opportunities to show what they can do. And it hasn't happened. So how much have they missed out on? They've missed out on hundreds and hundreds of 500% plus gains in that time, because one day it will mean revert, or it may mean revert. I'm sure at some point there will be some sort of turn back the other way, but it hasn't happened in all those years, and look at what they've missed out on. So for me, the way to approach this is to stay on top of the market. You don't, if you're not someone that's really attuned to the market, then align yourself with someone who is. But through one mechanism or another, stay on top of the market, and then be responsive when things do start to change and mean revert. Because you would have been so much better off along the way that even if you give a portion of that back, then you're still miles in front. So for me, that's the approach to take. Portfolio Analyst this week will be an ongoing review of just the tremendous opportunities that are just everywhere. There's almost too many of them to deal with at the moment. So that's it for this week. There's my email address, and there's more information on the website for anyone that's interested. And I'll be back with you next Sunday. Cheers.